So where are we going? Well, your next guest warns the market may not still have priced in the economic slowdown that could come. That could mean more days like this one. Mark Zandi is the chief economist at Moody's Analytics and joins us now. And Mark, you're kind of a consumer specialist. You heard us talking about the consumer. What the stock market is saying is that the consumer may be in trouble. Do you agree with that?
No, not in trouble, Brian. I mean, the fundamentals for the consumer are good. Lots of jobs, low unemployment, leverage is low. They've locked in these.
But the market's a discounting mechanism for the future.
Yeah, you're right. I mean, they may be discounting slower consumer spending growth, right? So the consumer's been on a tear in buying lots of everything, and that's been powering economic growth. And we do need to see the economy's growth rate slow. That's the Federal Reserve's objective here. And the key channel through which that happens is through consumer spending. And so we need to see consumer spending growth slow. And I'm sure the markets are discounting at least that. I don't think they're discounting the consumer pulling back, because that would mean recession. I don't think that's what the markets are saying, at least not yet.
Do you see a recession in the next 12 to 18 months, Mark? Because if you do, even a small one, we had a negative GDP print. We need to technically. But that was weird because of government spending and stuff. If we have one in the next 12 to 18 months, is the stock market then acting rationally, to quote Bonawyn?
Well, I think the economy is going to avoid recession. If it's going to be, close call. I mean, I think probabilities of recession are awfully high over the next 12 to 24 months. With inflation as high as it is, and the Fed trying to calibrate things in this very difficult environment, you got two major supply shocks out there still hurting the global economy: the pandemic and the Russian invasion. So recession risks are awfully high here, but I think we'll be able to navigate through. I don't think the stock market at this point is saying recession. I don't think that's what it's saying. It's saying, hey, look, interest rates are normalizing, they're going up. We got to adjust to that, and we need a slower growing economy. And by the way, profit margins, which have been extraordinarily high. In fact, if you go back, look at the data, margins are as high as they've ever been in the data we've got back to World War II. Hard to imagine that they're going to continue to move higher. So you add that all up, stock prices have to go lower. But I don't think it's adding up to a recession, at least not at this point in time.
Hey, Mark, it's Tim. We got some labor numbers today, productivity down. A lot of that's COVID-related, fresh lockdowns. But the labor costs are the problems here, I think. And I'd love to get your view as we get into a big payroll number tomorrow. You've been doing this forever. What would be the best number for the market? So put your fast money trader on. But tell me about the tightness in the labor market and that component of inflation that's really putting a lot of pressure on the Fed.
Yeah, I think the best number, Tim, tomorrow would be something like around 350,000 jobs created during the month, because that would show that the growth rate in the labor market is starting to slow. Because we've been at 500K per month on average for more than a year, and obviously that's really fast. Unemployment's been coming in very rapidly, and unemployment's already very low. So we need to see a step down in growth, and that would help calm the nerves in the bond market. You're talking about bond yields. It was an incredibly bad day in the bond market. And so this might take a little bit of concern out of bond investors. So some step down in growth, I think, would be encouraging. If we got a really hot number, something north of 500K, I think that'd be a problem. Something south of 350K low, I think the market probably would say that's probably measurement issue, seasonals, which are going to affect the numbers anyway. But something around 350K, stable unemployment rate, I think that would be the markets would enjoy that. I think they would find that very productive.
That certainly would be the Goldilocks scenario, and we're going to find out certainly if we get it, because this is a Fed that is threading a needle economically. Certainly, Mark Zandi, we can agree on that. Have a great day. Thank you very much. All right.
Yeah.
Karen, not to get wonky and weird, but at the end of the day, a stock price is simply the measure of the cash available after operating expenses and debt service. And then you sort of divvy that up and give it amongst the shareholders. I'm being overly simplistic. But I think Mark made a good point that if you think earnings have peaked, what else is there to look forward to? And I think maybe the market is telling us that story.
I guess, although I think all stocks are not the same, right? So I think there are some where earnings have peaked, and I certainly think the ones who are, pandemic beneficiaries, those earnings may have peaked. Certainly those multiples have peaked. But there are some that have just been thrown out with the bathwater, and I think that even if those companies don't grow earnings, that the valuation, the generation of cash flow will just make it too attractive. Something like a CVS, companies like that, that are, kind of boring, not sexy, weren't high flyers at any point, but just deliver. And so I think that those sort of, pedestrian kind of names are a good place to hide.